Hi, everyone. Welcome to the Wolf Group webinar on the U.S. taxation of cryptocurrency, which I'm calling 101. This is our basic webinar of discussion of U.S. taxation of cryptocurrency to get the basics of how the U.S. taxes cryptocurrency, the basic working knowledge. And so without further ado, we'll get into it. My name is Mishkin Santa. I'm the International Tax Director here at the Wolf Group. There's my background. There's our disclaimer. Okay, so we're going to jump right into it. And basically, we're going to start the presentation off by looking at cryptocurrency, past, present, and future. And again, we're just trying to get the folks that are watching a basic working knowledge of cryptocurrency and the US tax rules that apply to cryptocurrency. So a little bit of background. In 1983, the beginning of cryptocurrency, or what we call electronic money, was created by what we call David Chaum, and he created eCash, and then in 1995, he creates a second type of electronic money called DigiCash. The purpose of both types of quote-unquote electronic money is to have them be untraceable by any bank, government, or third party. What that basically means is that they are decentralized types of electronic money. So no one can change policy or create policy or dictate the supply. It is in its own decentralized state. In 1996, a year after DigiCash was created, the NSA published a paper about how one would go about minting or making cryptocurrency, and basically use the term for the first time, cryptocurrency system. We fast forward to 2009, and the first type of cryptocurrency, which is Bitcoin, was created by a person or a set of people called Satoshi Nakamoto. We don't know who this person is. Again, we don't know if it's a one person or a group of people. We don't know their location. But this quote-unquote person created the Bitcoin. I believe it was on Halloween of 2009, and it was used to purchase a pizza. Cryptocurrency basically gets its name from cryptography, and cryptography is the methodology that is used to secure certain transactions. So from the genesis of the word cryptography, we get cryptocurrency, and that's our starting point. Here in 2021, cryptocurrency is hot and heavy. I know a lot of people that just go on to their cell phones, they log into their Robinhood app, they sign up for cryptocurrency to buy and sell various types. So as you can see on the left-hand side of the slide there, I cut a slice out of the Robinhood app and added it in there. Basically says, if you want to buy crypto, it's open 24/7 and it's commission-free. So you can see that various companies are basically trying to route their customers into the crypto space for investment purposes. On the right-hand side, you'll see that I've copied in the 2021, what we call best exchanges. And so there's a variety of different exchanges that can be used to purchase cryptocurrency. They have a different way that they charge. There are various currencies that can be purchased through each exchange. They have different types of security and different types of transactions that they offer. Most people will know about Coinbase because Coinbase is in the news, but there are other apps, as you can see here. There's Cash App, Bisq, and then Binance US. So who accepts cryptocurrency? Well, Wikipedia, Microsoft, Burger King. So I guess you can get a Whopper with crypto these days. The Miami Dolphins, the Dallas Mavericks. If you want to buy season tickets to the Mavericks, you can use crypto or Bitcoin to buy that. Looks like you can book flights with Virgin Galactic or Norwegian Air, all the way on down to various apps. You can also purchase wine with crypto. I thought this was super interesting, one, because I love wine, but number two, it's kind of an interesting take that these different vendors are saying with the crypto. Hey, it's fast, it's secure, it's easy. People are looking to divest their assets into various, places. So if you have cryptocurrency, maybe you have a lot of it stored up and you want to buy, a nice wine that's going to appreciate in value, basically convert it to a tangible asset. We offer you the ability to do that through BTC Wine. I thought that was super interesting. They take a variety of tokens and they basically use an exchange called crypto.com, which you can convert euros into tokens. And I'm sure you could probably convert dollars too. There's also various auction houses. This one does wine as well, but there are other auction houses that take crypto. And so again, it's an option now. We're seeing it become more mainstream that various places that are selling goods and services are not only allowing cryptocurrency, but basically trying to push their customers into doing the crypto, again, due to the speed and security of the transaction. And the fees are substantially less as well too. Pro athletes have opted to be paid in cryptocurrency. So we can see here on the left-hand side, we've got the tackle for the Carolina Panthers, Russell Okon, basically saying, look, I'm going to take half my salary in Bitcoin. So the Panthers are going to have to go out and get a Bitcoin account in order to pay him in Bitcoin. They're going to have to still do the withholding tax for his salary in US dollars, which we'll talk about a little bit later. But these are things that are starting to become more mainstream. The #1 draft pick, Trevor Lawrence, has indicated that some of his signing bonus will be converted to cryptocurrency as a way to diversify his portfolio, which I thought was the super interesting thing. It's one of the first things he said when he was drafted by the Jaguars. I'm a big fan of the New York Giants, so I love Saquon Barkley, and it's always good to see kind of Saquon doing his thing. But also he'll be taking $10 million worth of endorsement money via Bitcoin. So he has a lot of different endorsements that he does for various types of athletic equipment and clothing. And so he'll be taking a portion of that in Bitcoin payment. And then Sean Culkin, I believe he may be a former tight end. I'm not sure if he's still with the Chiefs or not, but he's also interested in taking his salary in Bitcoin and says, hey, this could be the future of finance. So it's an interesting take again we have here where cryptocurrency has invaded now professional sports. Other things which will be in the 201 presentation, there are these things called non-fungible tokens or NFTs, which is basically a digital representation of a certain item, which could be like an image, a song, a game, a play within a game. And so they can convert that to an NFT and the players associated with it can sign it or can vouch for it in some way, shape, or form. And then they can sell that NFT as a collectible. And it's thought that the NCAA athletes that are now able to sell their names, images, and likenesses are able to basically utilize NFTs as a medium for selling certain things and getting income. And that ranges not only from your big name, Alabama quarterback, but it also goes down to sometimes hometown heroes, right? So if you have a hometown hero that maybe has done something big for the hometown, they can convert a digital image of a game they played in or something that they're good at into an NFT, and then they can sell that, which is part of their name, image, and likeness for income. There are crypto trading cards, which are really hot for international soccer. So that's a big thing that's currently occurring. NBA Top Shot, very similar to the NFTs, is basically taking NBA plays. So for example, maybe the Giannis block in the NBA Finals, converting that to an NBA highlight Top Shot, and then selling that as an NFT signed by him. Nike is doing crypto kicks. So it's a digital shoe created as an NFT and then sold on the open market. So as we can see, this is becoming more and more mainstream, more and more relevant. It's becoming an option in a lot of various industries. I like looking at the cryptocurrency rich list every time I do this presentation, just to make sure I know who's on this list. The funny part about it is that this list will change on any given day, depending on the market for crypto, because it's so volatile. The person that's in the lead could drop down to like number 20, and then the 20th person could drop up to number 1 or could move up to number 1. So it's a constant changing, rotating list depending on the amount of crypto assets that each of these individuals have. But what I always think is funny is that Tyler and Cameron Winklevoss, the Winklevoss twins from Facebook, always manage to hang in the top 10. They're always in there around 7, 8, 9. They're always there. They never really fall out. So they've probably done a good job at maybe converting whatever crypto they had into actual USD or maybe some kind of stable coin to make sure that it's not fluctuating as much as some of these other folks. For future purposes, and again, we'll talk about what is crypto, what is Bitcoin, but in general, there is a maximum amount of any type of cryptocurrency that can be produced. It's a controlled supply, which again we'll talk about. But for Bitcoin in particular, there's a maximum amount of 21 million coins that can be put into circulation, and the program basically says that from the first point in time in which the coins were mined, which we'll talk about here in a little bit, to the very end of the program, which will be in the year 2140, the Bitcoins will come out at a certain pace. So at the very beginning, they come out fast and heavy. And then as time progresses, they get slower and slower and slower and harder to get Bitcoins from mining. And in the end, the last Bitcoin will be mined in the year 2140 per the program, assuming people are still doing mining at that time. Recent studies predict that there may be as many as 200 million individuals that hold or use crypto by 2024. I actually think that's going to go a lot faster. I think maybe by 2022 or 2023, we'll have exceeded that number already. Okay, so what is cryptocurrency? And again, cryptocurrency is the hybrid of a lot of different things that we already know about. And that's where I think people have to wrap their heads around. It's not going to fall into money. It's not going to fall into a contract. It's not going to fall into a security or a commodity. It's going to be a hybrid of all of those things. And you can't really try to box it into something that we already have. It has to have its own new definition. But the main thing that you can kind of wrap your head around with crypto is that it is a medium of exchange. That word, though, that set of words, that phrase will be uttered over and over again. It's a medium of exchange, which you can use to pay for goods and services. You can hold for investment. You can use to verify contracts. It's part of a decentralized system, which means that there's no government or bank that monitors or controls it. And it's held or stored electronically in what we call a digital wallet. Transactional properties. So it's irreversible. If I do a transaction and I send it off, I can't get it back. So if I on accident send you 5 Bitcoins when I meant to send you 1 Bitcoin, I can't say, whoops, bank, give me my 5 Bitcoins back, because there is no bank. Once it's out there, okay? And in some cases, we've seen that some of these wallets that are controlled by various what we call keys, which we'll learn more about in the 201 presentation, some folks will lose that. They'll lose a key to access their wallet. And again, if you don't have it, you can't access it. And then there's no getting back into it. It's like you can say, oh, I forgot my password, or I wasn't able to remember my 4-digit PIN for the ATM. I mean, it's that serious where certain things cannot be undone. Okay. These things are not really connected to real world identities, although I will say that I find it funny. For example, when you have certain things that have happened, for example, scammers scam governments or local jurisdictions out of a ton of money, and then maybe like 2 weeks later, the FBI was able to track down the crypto payment to the people that did it and arrest them. Obviously, there is some real world connection there. There is some tracking that can be done. So that's why it's not totally anonymous, it's pseudonymous. But it's, there's masking there of identities related to who's using the crypto. It's fast, it's super fast. I can literally get a cryptocurrency transaction verified in probably 10 minutes or less. So if I'm physically inside, the BTC wine shop, it's about a 10-minute process to make sure everything gets verified. If I'm doing it kind of online, it can go even faster, okay? It's secure. Supposedly, cryptography makes it more secure than Fort Knox, although, I think that probably be something that will be tested over the next couple of years. And it's permissionless. Monetary property. So as I mentioned earlier, it's a controlled supply. Each type of crypto has a schedule written into its code. There's an algorithm that says, this is how much of this crypto exists, and this is when it can come out. And that's based off of the actual mining activities that occur with that crypto. There's no debt associated with crypto. So crypto does not represent any kind of debt whatsoever. It just represents itself. When you look at various government agencies, they all try to classify crypto as something different, which makes it a little difficult to try to, again, give a good working definition of what crypto is and how it should be treated in various circumstances. Because, for example, when I'm talking to a client about their crypto, I may be speaking about it as personal property for tax purposes, but then I also have to walk them through that, for SEC purposes, it's not a security, right? But it could be in the future. Or for the CFTC, it's a commodity, and so there's special rules that we have to deal with commodities. And then for FinCEN reporting, it represents money. So there may be certain reports that have to be filed to, illustrate that to FinCEN. So again, I think that right now we're in this hodgepodge in the US where we have different classifications by different agencies. And so you have to be very careful that you're talking about all the various hats that crypto can wear when speaking about it for various transactions. Okay, types of coins. And I'm going to give you basically 4 types of coins here. These are, in my opinion, what are the quote unquote general coins. So Bitcoin is the main coin. Again, it was the first coin that was developed. It's the founder of the feast. It's the numero uno. From there, we have what are called altcoins. And altcoins are any other cryptocurrency that comes after Bitcoin. Then we have what are called base coins, which are basically pegged or tied to another asset. So maybe they can be tied to the consumer price index, for example, okay? One that people may be familiar with more than others are what are called stable coins. So stable coins will be linked to, say, the US dollar. Maybe they're linked to another type of crypto. So maybe there's a stable coin that's linked to Bitcoin. Or some kind of commodity-backed stablecoin. There's different types of stablecoins that have been issued, and I know that, for example, the Gemini dollar is really popular. Paxos is very popular. Tether is very popular. Those are really good examples of stablecoins that people seem to like. For investors, though, I think investors really are interested in stablecoins because not only are they backed by something else that makes it "quote unquote" stable. But there's different asset classes that can evolve over time with the various types of stablecoins. So we could see like a Gemini 2.0, a Gemini 3.0 that have various different links back. So the Gemini dollar could be linked to the US dollar, Gemini 2.0 could be linked to Bitcoin, so forth and so forth. The advantages of a stablecoin, again, it's backed by something else, so it doesn't tend to fluctuate as much. So for example, other types of coins, you could go up by $100,000, $200,000 on a whim. So it could be up high today, and then tomorrow it could drop $100,000. With stable coins, you typically don't see that level of fluctuation in their value because they're tied to something else. And that then reduces the financial risk. The downside to these stable coins is that some of these things can go out of business. Sometimes they have unaudited financials that can't be verified. And so we see here that Tether basically is saying they're worth millions and millions of dollars, but there's nothing to verify that value actually exists from an audit standpoint. Stablecoin project called Basis, which received over $100 million of venture capital funding, shut down in 2018. And so again, that's lost investment funds that occurred for that particular coin. The Bank of International Settlements really likes stablecoins because of all those things that are listed on the slide. They basically protect a lot of what they're trying to do at that bank. Okay, blockchain and timestamping. So one of the things I always tell people is that if it helps you to think about cryptocurrency and the blockchain and what that is, think about that each cryptocurrency represents a mountain. Okay, so there's a mountain of different cryptocurrencies, and the miners are basically mining that mountain to pull the crypto out of there. Okay, when the miners pull the crypto out of the mountain, the blockchain is like a railroad that connects all the mountains together and verifies all of those transactions. Okay, so anytime a transaction occurs within the cryptocurrency mountains, or a transaction occurs between users of cryptocurrency, the blockchain is basically keeping a ledger of all of that activity. And it's also date and time stamping everything so that you know exactly when a transaction occurred and how it occurred. And people that are mining are basically solving out algorithms and verifying transactions between users of the cryptocurrency. So again, it's a decentralized system that is controlled by the users, of which transactions are verified by the users. And that again is done on the blockchain. Okay, so I've said the word mining a couple times, and when people think about mining of cryptocurrency, it kind of looks like this picture that I displayed there. It looks like they're actually like, going into the computer and pulling out the crypto. But basically, again, mining is solving complex math algorithms, which basically verify transactions on the blockchain. So the basic terminology is you solve an equation, you get a Bitcoin. Now, mining is typically done with a lot of computer hardware. It soaks up a lot of utilities, a lot of energy. And so we typically see very large, what we call mining farms, in places in the world that have very cheap power or electricity. So examples of that would be Southeast Asia, China. That's where we normally see it. When people tell me that they're doing mining inside their home inside the United States, it's kind of to me, it's not a equitable proposition, because the bill to fund the power that goes into your mining setup is going to be so extraordinary that it's probably going to soak up a lot of the gains that you have from the mining. This is a slide that was produced by the GAO, and I think it does a fantastic job at basically walking through the process of mining. So you can see it's got this 5-step process where it's got the person sitting behind the computer, they're mining, they're taking a look at the wallets and addresses, someone then makes a purchase with Bitcoins, there's folks that are then verifying the transaction is complete, and then one of those folks that's verifying the transaction actually wins the Bitcoins for verifying it. So again, solve an equation, get a Bitcoin. This is just an example of what a crypto mining setup looks like. And so when I said it takes a lot of power or juice to run these setups, I really mean it. This is actually a very tiny crypto mining setup. It's picture warehouses of these types of setups that are running the crypto operations in Southeast Asia, China, Bulgaria, places like that. Okay, so now that we've got the basics of cryptocurrency down, let's talk about the actual tax rules that apply to the taxation of cryptocurrency. So first and foremost, in the beginning, which is kind of where we're at right now, there are no specific sections of the Internal Revenue Code for cryptocurrency. Congress has yet to legislate on this topic. They have not put down one rule or axiom for cryptocurrency. They've produced a lot of letters asking the IRS to provide guidance, to provide rules and regulations, administratively speaking. But I think in turn, the IRS is kind of looking back at them and say, well, look, why don't you create laws governing cryptocurrency? I mean, you've got potentially another change to the tax code coming up here in 2021, and why don't you just add in some cryptocurrency rules there? That way we can kind of then come off of those and create regulations and more formal guidance. So it's kind of the circular chain of finger pointing. And I don't think that anyone really wants to take the lead yet on what cryptocurrency is, because once you do, you're determining the policy that's related to that. And again, I think that really has to come from Congress and the president. So what we have in regards to guidance from the IRS is administrative only. And it basically started in 2014, where we had notice 2014-21, which was published in the IRS Internal Revenue Bulletin. So it's actually guidance that you can rely upon. But basically what happened is that notice 2014-21 treats cryptocurrency as personal property for tax purposes and applies general tax principles to personal property transactions, okay? It defines cryptocurrency as a digital representation of value that functions as a medium of exchange, a unit of account, or a store of value. And yes, I had to read that off because I'm not going to remember all of that. But if you really want to see kind of the genesis of where cryptocurrency started at in regards to the IRS and how they view it, you definitely want to go back and read notice 2014-21. That kind of gives you a good baseline for where they're starting at and their position. Okay. From there, the IRS, which they've done a lot lately because they just simply do not have the ability to write the manpower to put out a lot of proposed regulations and different types of revenue procedures and things like that. They've basically been issuing guidance to what we call frequently asked questions. And so we've seen this with a lot of different areas. We've seen this with the streamlined procedures. We've seen this with transition tax. We've seen this with employee retention credits and things like that. The frequently asked questions for cryptocurrency just like other frequently asked questions, people have to understand that this is not a formal guidance. You cannot rely upon this, generally speaking. The frequently asked questions can also be revised at any point in time. So what I normally tell people is that if you're going to rely on a frequently asked question, print out that page, save it to a PDF, print it out, highlight the time and date stamp on it, because tomorrow that FAQ could be replaced, it could be removed, it could be gone. And then if you try to go back and say, well, I relied on FAQ 8 for the crypto, and it's something completely different when the IRS goes to look at it, it's not going to hold any water. So you definitely want to make sure that you're printing out the guidance that you're relying upon when it comes to an FAQ, and that applies to any FAQ in any topic. Okay, so currently there are 46 FAQs for cryptocurrency, and I've included the link to the FAQs in the presentation. When it comes to figuring out how to tax a transaction, I would always start with the FAQs just to make sure that you're thinking the right thing. And so, for example, I had a question come to me the other day about, how do I calculate the basis of this crypto asset? And the person that asked me basically answered their own question, but they answered it incorrectly. And so I said, really what you should do is go back to the FAQs, see what they have to say, and make sure you incorporate that into your thinking instead of just trying to freestyle how you think the crypto will be calculated. Okay. We have revenue ruling 2019-24. So there is a revenue ruling for crypto. This one basically is in relation to airdrops and hard forks. I will note that I regularly will define these terms when I'm talking to people, because what you may think a hard fork or an airdrop is may be something completely different than what I'm thinking. And I think it's always good to say, this is what I believe a hard fork is. Do you agree or disagree? And then kind of come to an understanding as to the terminology that's being used. And I would tell you that I think the IRS would be served well by starting off any future guidance and saying, hey, this is the definition of these things according to us, so that everyone is on the same page with what they're thinking that is. Because again, I can interpret an airdrop different from what the IRS means it to be. Okay. But in this context, an airdrop is basically going to be a new coin that's created in the process of what's called a hard fork. So what's happening is that we have a token or a coin that's just moving along like Bitcoin. And then one day the community decides that it should have some different properties and maybe serve a different purpose. And so a second coin is created out of the first coin. And a good example of that would be Bitcoin Cash. So we have Bitcoin, and then Bitcoin Cash was created in a hard fork and is a brand new coin. Well, when that happens and the actual new coin is then put into the end user's account, that's called an airdrop. So when I receive that new coin, that Bitcoin Cash, I then now have a new asset that I'm playing with. And at that point in time, the fair market value of that asset is going to be taxable to me because of the airdrop hard fork rules under revenue ruling 2019-24. Okay. Income and capital gains tax. This is what's going to govern the taxation of cryptocurrency. Remember that the IRS looks at cryptocurrency like it's personal property. So basically what's going to happen is you have to think that most crypto is going to be what we call a capital asset, okay? And when you have a capital asset, there are very specific rules, gain loss rules for a capital asset, okay? And capital assets are typically going to be types of property that are held for investment. So when you have a capital asset, you're basically going to have either a short-term or long-term capital gain when you dispose of it, when you sell it, when you exchange it. Okay, so if it's a short-term gain, it's going to be ordinary income, currently taxed up to the highest rate of 37%. Under the Biden plan, that would go back to 39.6. If it's a short-term loss and you're married filing jointly, you can take up to $3,000 of short-term loss per year against ordinary income. If it's a long-term gain, then you're going to be taxed at normal capital gains tax rates, so 0, 15, and 20%. Under the Biden plan, certain incomes over $1 million would be taxed at the highest tax rate, which would be 39.6% under the Biden plan. And then you have the additional 3.8% net investment income tax, which tops out your capital gains tax rates at either 23.8% currently or 43.4% under the Biden tax plan. And again, long-term losses have the same impact as short-term. Wash sale rules. So I get this question asked all the time. Do wash sale rules apply to crypto? And I'm copied in a slice of an article I read recently back in May, where it talks about the quote unquote loophole, which there are not very many of anymore. And this is a big loophole for crypto because basically the IRS is silent on the wash sale rules, which most people interpret as they don't apply to crypto. There was a very persuasive article by Caitlin Toe. Hopefully I said that name correctly. Back in October 2020, I read it. I thought it was great. And she basically argues that the wash sale rules should apply. It's a very similar type of process with stock trading. And to implement the wash sale rules would prevent certain types of abuse. Okay. So what is the cost basis of cryptocurrency? The cost basis is typically going to be what we call the acquisition cost. So what did you spend to obtain the cryptocurrency? That's going to be your cost basis. And typically that's going to be the number of units you purchased times the value of the coin at the time of purchase on an exchange. Okay. In some cases, you're going to be able to add in the fees and commissions and maybe other reasonable and necessary costs. So for example, if I'm mining crypto and I obtain a coin, obviously there were costs associated to obtain that crypto. So that may change the basis of my coin. Some of these exchanges have different fees that you have to pay to do transactions. And so some of those could be used as adjustments to the basis of the coin. What is my amount realized if I receive crypto as payment for goods and services? Well, typically speaking, when I receive crypto as payment for goods or services, I basically need to take that crypto, I need to identify it, I need to go to a listed exchange, and I need to find its value as of the date and time I received the crypto for the good or service that I provided. And whatever manner that I choose, or whatever method that I choose to do that, has to be reasonable, and I have to do it consistently. So for example, if I'm using exchange X for transaction number 1, and then exchange Y for transaction number 2, and exchange Z for transaction number 3, that's not going to be a consistently applied manner. So you need to try to use the same exchange for all of your transactions and say, this is the exchange that I'm going to use for my crypto transactions for this calendar year or for the foreseeable future, until the IRS gives us better guidance on what exchange we should be using or the preferred exchange. And the reasonable manner, obviously you want to choose an exchange and a method of exchange that is reasonable, that's not illogical. So for example, some people may believe that certain types of crypto are worthless, but on certain known exchanges, they actually have a worth to them. So it has to be a reasonable exchange calculation when you're determining the amount realized. Okay. And again, there's two different ways to go about this. We have what are called on-chain transactions, which typically occur within registered exchanges. And that's pretty easy to find, right? So if I'm doing a transaction on Coinbase, Coinbase has an exchange, it's an on-chain transaction. It's gonna be very easy for me to look up the value of the crypto that's received or paid out in that circumstance. If it's a peer-to-peer exchange, which can sometimes be what we call an off-chain transaction. So for example, we're not using an exchange. I have a wallet that's personal to me. You have a wallet that's personal to you. We're doing a transaction that no one else knows about. It's just between the two of us. Okay, what's called a peer-to-peer transaction. It's off-chain because again, it's not linked to an exchange. I then send over a coin. I then need to go to either a global pricing index or a blockchain explorer and then calculate the value of the coin based upon the time that it was exchanged and convert that to US dollars. So those are the different ways that the amount realized can be determined. In some cases, there are crypto that are not going to be published on an exchange or anywhere, to be honest with you. At that point in time, the default would then be what the fair market value of the good or service provided is. So if, for example, I'm providing a service and my billable hourly rate is $2.50 an hour, I spent 2 hours on it and you gave me a coin, then the fair market value or the amount realized at that point in time would be $500. And that's what you would use for your amount realized when you're reporting that as a taxable transaction. Your accounting method is pretty critical. And this is something that I see a lot of people bouncing back and forth on. Again, it's got to be consistently applied, which means you can't bounce back and forth. You can't say I'm FIFO 1 year and then specific identification in year 2 and then back to FIFO in year 3. Basically, whatever type of accounting method you choose, you should stay with. And I will tell you that my preference generally is going to be specific identification. I would say almost 10 times out of 10 produces a better result than FIFO. This example that I have here kind of walks you through the general outcome of that is much better under specific identification than it would be under FIFO. So for example, here we have what's called NXT that's being converted to Bitcoin. When that happens, we have a taxable gain of 9,000. Okay. We then have Bitcoin that's converted to US dollars. And if we use FIFO, we're going to take some of our older Bitcoin to get the money, to get the coins to US dollars. And that is going to produce an $8,000 taxable gain. Okay. Because some coins you have to convert from the coin to Bitcoin to US dollars. So there's a dual transaction to convert the money to USD. In that case, you then have a $17,000 total taxable gain. Whereas if we use the method called specific identification, and maybe what we're not converting is the older coins, maybe we're converting some of the newer coins. So we're not using FIFO, we're using specific identification. We limit the taxable gain to $9,000. So that's a huge savings. And again, I see this all the time. I see this very regularly where my folks will run the math under specific identification. They'll run it under FIFO, and almost, again, 10 times out of 10, specific identification wins the day. And so how do I do specific identification? Because that's what the question is that I get all the time from various folks. They say, great, sounds like an awesome method. What exactly do I need to do to employ this or to make it happen? Well, there's basically 3 different options. There's what's called a unique identifier method, there's a wallet identifier method, and a transaction identifier method. Under the unique identifier method, you basically get the raw data and you try to find the unique identifier for each crypto asset, which is easier said than done. But basically the way you do that is you find the address of the crypto and it's linked to the private and public keys. And again, we'll talk about private and public keys in the Crypto 201 class. Okay, the unique identifier method is a very burdensome approach, and you also have to be able to use technology that allows you to access that information and link it up to the transactions that you're having. In my opinion, it's not the best one to use. I like the wallet identifier method because basically what happens is that for every crypto asset, you have a different wallet. And so it's easy to kind of track, this is the crypto coming in, this is the crypto going out. The downside to the wallet identifier method is that if you have multiple wallets and you have multiple transactions flowing between wallets, you then have to map those wallets together to know the starting point and end point of each transaction. And that can get a little convoluted. So you have to be very careful that you don't sacrifice your method for setting up a more very convoluted type of tracking. And in the end, if you're not the one tracking it, if you end up giving this to your accountant or your CPA, it's going to take a lot of time for that person to map that and unwind that. So it's best to try to set this up from go instead of trying to do it after the fact. Okay. Option number 3 is my favorite option. If you can get this done, I think it's fantastic. It's called the transaction identifier method. And basically what happens is you use a transaction ID or a hash or UTXO that's linked to the various cryptos. And then it's really easy to kind of see, okay, this is Bitcoin 1, this is Bitcoin 2, this is Bitcoin 3. And you can literally create yourself a little legend of the various crypto that you have and which ones went out and when. So again, I think if I'm looking at all 3 of these, I would say use the one that you feel most comfortable with, but I definitely prefer option number 3. Okay, crypto investors. So we're going to switch gears a little bit here and talk about the various types of folks that enter the crypto space. The first is what we call crypto investors. And there are a lot of these folks. I see them all the time. Crypto investors, and again, this goes back to that Robinhood slide that I showed at the very beginning, or some of the different brokerage firms that are now offering crypto. Basically, what's happening is you're taking your dollars or your money, you're converting it to crypto, and then you're looking for some kind of capital appreciation, right? The markets rise, you want to capture at the high point, and you want to pull your money out, get your money back, and you have some appreciation in your money at that point in time. These folks are not operating a trader business. As we discussed earlier, capital asset treatment will apply. And expenses such as fees and commissions, if they're not part of the basis, could be deducted, but not until January 1st, 2026, because under the Tax Cuts and Jobs Act, the 2% floor went away. So you can't deduct those fees, just like you can't deduct wealth management fees or tax preparation fees. But when the law changes, you will be able to go back and deduct those types of things. Crypto traders. So crypto traders are a little bit different than crypto investors. And I saw a lot of crypto traders during the pandemic. My general opinion is that people got bored during the pandemic. They maybe watched everything they could watch on Netflix or one of their streaming devices. They wanted something else to do. And so buying and selling crypto in a very hot market, trading very quickly seemed to be something that a lot of people like doing. And so I ended up seeing a lot more crypto traders, during for the 2020 tax return than I did in the prior year. But basically what's happening is that people are buying and selling crypto for their own purposes, not for, sale to other people. They're doing short-term transactions. So it's a lot of buy, sell, buy, sell, buy, sell. That is a trader business, or can be construed as a trader business. So you can offset expenses with that in certain situations. And you can do what's called a mark-to-market election, which we actually did for several folks, both residents and non-residents. And we'll talk about the options available with the mark-to-market election and IRC 475 and the 201 presentation. But basically what happens is that under the mark-to-market election, the crypto is treated like a commodity, which allows you to use that mark-to-market election to take certain advantages of those short-term trades that were done. Okay. Crypto dealers, there's not a whole lot of these folks, even during the pandemic. I did not see a spike in these types of folks. But basically what crypto dealers are people that are trying to obtain various types of crypto tokens. If you go back to the beginning of the presentation, you can see the different exchanges and types of cryptos that they offer. I think one said they offered 64, one was 128. There's a lot of varietals when it comes to cryptocurrency. There's a lot of different types of tokens. A crypto dealer will basically try to acquire various tokens and then have them for sale to customers. So, when I was down in Australia in 2018, if you went to go buy something at the grocery store, right outside the grocery store, there was a crypto ATM. And basically, if I needed to quickly get Bitcoin or some kind of crypto, I would just go to the ATM, exchange my Australian dollars for crypto, and then bam, I've got cryptocurrency. The person that's selling that crypto is a crypto dealer. And in the United States, it's basically the same thing as a crypto trader. The only difference here is that if the crypto is ever classified as a security, then the dealer must mark to market under 475. It's not an option to do the election. Okay, other types of taxes, because I think we have to make sure that we're covering the full spectrum of all taxes that could be involved. Currently, cryptocurrency is not subject to sales tax yet. We'll see if states decide to make it subject to sales tax. But when I sell crypto as a dealer, it's not subject to sales tax. If I purchase a good or service with crypto, then sales tax would be due in most jurisdictions. I think there was recently a ruling by the state of Washington on this topic. People were buying goods and services with crypto, and they have a pretty hefty sales tax out there. Withholding tax, as I mentioned earlier, for Russell Okong and him getting half his salary in Bitcoin, the Carolina Panthers will still have to do federal and state tax withholding. So there'll be federal withholding for the IRS. There'll be North Carolina state withholding. I'm sure there'll be other state withholding taxes for the various jurisdictions that he plays in. But that has to be done in US dollars. You can't remit crypto to the IRS quite yet. So those things have to be considered because that's a liquid cash event that has to be produced to do the withholding tax and the various payroll taxes which apply. In some cases, there's what we call backup withholding or non-resident alien withholding when you're making payments to non-US folks. And if you do that with crypto, that's still required. So you may still have to send US dollars to Uncle Sam on different types of withholding related to payments to non-US persons. Gift and estate taxes do apply to cryptocurrency. And so it's very similar to how you would do a stock. So the donor's basis equals the donor's basis at the time the gift was received, and the holding period transfers over if it was a gift. Okay. Things that do not apply but have been mentioned about cryptocurrency are value-added taxes, which we don't have in the US. A digital services tax, which I know is a big hubbub in a lot of different jurisdictions at this point in time. And then some people have even contemplated adding in what we call a federal gambling tax. Now we have an income tax on gambling income, but potentially there could be a quote unquote gambling tax on certain types of things, and one of which is cryptocurrency and certain cryptos that are considered gambling. So one of the things, those are things that may be in the future or on the horizon for crypto. Other taxes, the US exit tax, which I do a lot of analysis on this, but yes, crypto does fall into the net for exit tax purposes. You do have to value it for the net worth test, and if you are subject to the US exit tax, then it's going to be a mark-to-market sale of the crypto, so probably a capital asset transaction. And you would find the crypto, the fair market value of the crypto on the day before expatriation. That's how you would determine the endpoint for sale purposes or for the phantom sale purposes of the exit tax. For compliance and documentation, it's going to be the 6001 rules, and basically similar to just about anything else. Keep the receipts, keep your CSV files, keep as much documentation as you can. I've seen some people present us with just a one-page PDF of certain things, bought for X on X date, sold for Y on Y date. That's not helpful. That's not going to give you what you need. You have to have date stamps, time stamps. You have to have, when did things get exchanged? What was the disposition? What's the transaction ID? What's my accounting method? All that stuff has to be documented. So the same rules apply, but the documentation at this point in time is probably more extraordinary than, say, other sources of income or other assets. And what I would tell people is, when in doubt, over document. Especially if you get into an audit with the IRS, it's going to be very difficult, in my opinion, to try to recreate documentation for prior years going backward. That can be a real hassle. This is a snip from our tax questionnaire related to virtual currencies and cryptocurrencies. These are some of the questions that we generally ask all of our clients to certify whether or not they have these types of assets. This section tends to grow every single year. And it's a funny story. When we first started putting out our questionnaire, I remember that we got one back from one of our older clients who doesn't use email. I have to call the client and talk to them over the phone. We have to mail everything off to them. It's a great relationship. They've been with the firm for a very long time. But the client had checked that they did have cryptocurrency. And when I called the client, she'd indicated that she had purchased crypto with her grandson as kind of a way to bond with him. And she started naming off, I've got Ethereum, I've got Bitcoin Lite, I've got, just kind of going down the list. And I was just in shock because, I would have never thought in a million years this client would have had crypto, but, don't judge a book by its cover. Anyone really could have crypto. And so you have to ask the questions, make sure that you're really getting into depth with what people have here. Don't just assume that, the person does or does not have crypto. The IRS wants to know, they want to know about taxpayers having crypto. So similar to Schedule B, Part 3, where they ask about foreign financial assets, the IRS in 2019 introduced this question onto Schedule 1 of Form 1040. Did you receive, sell, send, exchange, or otherwise acquire a financial interest in cryptocurrency? And you had to answer yes or no. The problem with this question is the placement. It's on Schedule 1 at the very top, and it's very difficult to notice. That's my observation. And number two, if you didn't have Schedule 1, you didn't have to answer the question. So a ton of people just got a pass for answering this question on their 2019 tax return if they didn't get the Schedule 1. So in 2020, the IRS decided to get smart, and they put the question on page 1 of the 1040, right underneath the general information block. Again, I still think that that's tough to see. Like if you're just looking at it from a distance, you might not even notice that the question is there in the middle of the page. Most people don't even notice the standard deduction section that's right below that as well. That's always something that kind of pops out to people that they don't realize. But it's something that you have to take very seriously, because now there is no way that it would not apply. Every single person has to answer the question yes or no. The wording in the question did not change at all for 2020. However, a draft 2021 return has been put out by the IRS, and they did change the wording on the question. So now instead of acquire a financial interest, it says dispose of a financial interest, because that's really what the IRS is trying to get to. They want to know, did a transaction occur where you disposed of an asset that's cryptocurrency that needs to be reported on the tax return? And if it did, then you must check that box, yes. And that question is not only on the 1040, that's on the 1040-NR. So one topic that we'll talk about in the 201 presentation is G4, or international organization taxation. And those individuals are subject to a very special rule, Internal Revenue Code 871, on capital gains tax. And so if they're buying and selling crypto, but they're inside the United States physically and meet the requirements of 871, they will then have a taxable transaction at 30%, and they must check that box as well too. So a big issue there for 2020 and 2021 moving forward. If we read the instructions to Form 1040, it's basically going to tell you what I've already told you at the beginning of the presentation. If you have an airdrop with a hard fork, that needs to be reported. If you have an exchange of one currency for another, so in my NTX example or NXT example to Bitcoin, that's going to be an exchange. That's going to be a taxable transaction, whether or not there's gain or loss. It still has to be reported. If you sell crypto, if you dispose of crypto, all of that needs to be reported. Okay. A transaction does not involve just holding crypto in a wallet. So there's a lot of people that may have just purchased the crypto. So you log on to Robinhood, you purchase some Bitcoin, it's just sitting there. That's not going to be a transaction that needs to be reported. If I have two wallets, I have wallet A and wallet B, I purchase crypto and I then transfer some of it to another wallet, but there's no disposition event or exchange event, that's also not a transaction that needs to be reported. Under current law, and again, there is no Internal Revenue Code that deals with crypto quite yet. So again, we're using basic principles of taxation of personal property. But basically, however the crypto is disposed of, exchanged, where there's a transaction, you have to make it akin to something else. So generally speaking, if you're an investor, you're going to report the disposition of crypto on Schedule D, Form 8949. If you're in a trader business, such as being a trader or a dealer, then likely that's going to go on to Schedule C, and self-employment taxes may apply to that as well. So whatever the equivalent of the transaction was for other things, that's how you would then report that cryptocurrency transaction. The IRS has all sorts of sneaky ways of kind of figuring out if you have crypto, so be real careful to look at the forms closely. This is what we call a collection of information statement, which is typically used to set up a payment plan with the IRS. And as you can see, they have basically indicated that you still need, you'll need to list the crypto and the value of the crypto for them to allow you to have a payment plan. But it's also a way that they can kind of go back and say, oh, well, you've got these different types of crypto. Did you check that box? Did you report certain transactions? So be very careful of how you're answering the questions on the IRS forms, and make sure you scrutinize them closely. For FBAR purposes, it's been long taboo to, do you report offshore crypto? What is offshore crypto to begin with? We don't really know how that's really defined. Some people believe that it's offshore crypto if the server is offshore, but that I can tell you from my own personal research can be a very painstaking research task to find out where the server is actually located. FinCEN has basically put out and said, look, we don't expect crypto to be reported on FBARs through 2020. However, we do propose that at some point in time it will be listed on the FBAR in some way, shape, or form. And we'll talk about in the 201 presentation some of the proposed changes by Treasury to the reporting of cryptocurrency, which is super interesting and may have a big impact both on domestic and foreign crypto. So this is an area that I think a lot of people have to keep an eye on, because again, if you have a crypto reporting requirement on your FBAR and you don't do it, you're risking a $10,000 penalty for an incomplete FBAR. And in some jurisdictions, it can be $10,000 per asset not reported. So if I had perhaps, 5 wallets, 5 offshore wallets, or 5 wallets that are considered, in an offshore location with crypto, and I didn't report any of those, then, that in some jurisdictions could be a $50,000 fine. IRS Form 8938. This question has been asked to Chief Counsel many times. Does it go on there? Does it go on Part 6? They have not said no. And so based off of their non-committal to whether or not it should go on there, the conservative path is to report what you believe to be offshore virtual currency on Form 8938 as an other foreign asset. You basically put it into Part 6 and you enter it in as indicated below. I think a good rule of thumb is to always report any offshore crypto on the Form 8938 until we hear otherwise. And then last but not least, for the Crypto 201 presentation, which is the next one, I'm going to go into a variety of enhanced topics. So we're going to get deeper into the NFTs. If you look back at the history of NFTs, the first big one was Tom Brady, which sold for a ton of money, but there's also a bunch of artwork that's come out through NFTs as well. We're going to really get deep into mining, solo mining, pool mining, cloud mining. We're going to take a look at proof of stake or staking, which is something new that a lot of people are getting into. We're going to take a look at the way that crypto is kind of being introduced into the market these days with the ICOs, IEOs, and STOs. There are different ways that crypto is coming into being. There was a huge ICO craze back in 2017 that quickly died out. But what's happening now is we're seeing a lot of STOs and IEOs that are being the method in which crypto is hitting the market. We'll talk about some of the proposed changes in the Treasury Green Book based off of what people refer to as the Biden tax plan. We'll talk about Treasury and their kind of take on the way that virtual currency should be reported in the future, changes to 3 different sections of the Internal Revenue Code for that. We'll look at some really significant and recent court cases for crypto. There's some really good ones out there that will tell us a lot once they're decided. We'll talk about how private letter rulings work with crypto, because I think that's a huge area, especially if you have a lot of value there and you need a straight answer. I think the private letter ruling is a great option. They're super expensive, but I think they could be a good option. We'll talk about the tax treaty and how the overlays of taxation of personal property apply. We'll talk about the foreign tax credit disparity with other countries and the way that other countries treat crypto. We'll look at indirect investments of crypto. Again, I said I would talk more about the non-resident alien taxation of crypto, which applies to international organization employees, typically, and also diplomats and maybe some students. So your A visa, your G visa, potentially your F and J visas, and your M visa. And then last but not least, we'll look at what the IRS is up to. They have a compliance campaign, they have civil enforcement, they have criminal enforcement, and then we'll wrap up with amnesty programs are the best way to come back in compliance. And so with that, I'm actually going to be out of time for questions, but we'll take a look at the questions, if any, that were proposed, and we'll definitely get the answers out to those folks individually. We appreciate your time today. Thank you so much.